Hello everyone, welcome to our discussion about Chapter 10. We're going to take some things that we learned from activity-based costing in Chapter 9 and apply them to the concept of the value chain from way back when we started class in Chapter 1, and the idea of what our customers are willing to pay for. And the whole idea is to manage our costs. One of the things that activity-based costing kind of helps us see, hopefully, is that if you're going to manage your costs, you've got to manage the activities. You've got to break it down into smaller pieces. You can't just focus on direct labor and direct materials as much as you want to make sure those costs are reasonable. You also have to look at the overhead and how those activities are managed, and that is driven by certain things you do. And if you can find better ways to make that more efficient or even eliminate certain activities, then you are going to be able to be more effective and more cost effective, especially. All right, so remember, the idea of value chain is the things from all the way from the very basic raw materials up through when we deliver the product to customers, and even after the fact, the customer service provided after that. That's the value chain. That's what the customer sees as the value they're getting for your product. Okay? So we're going to, now that we have it kind of as construct to work with these activities and break things into activities, we want to manage those to provide the lowest possible cost and still provide the value to our customers. We certainly don't want to compromise on anything that they are willing to pay for or the values they do see. All right? And doing that, we're allocating. Remember, we don't change a lot about the direct materials, direct labor, but we do allocate overhead differently using activity-based costing. So the process, if we're going to improve and get better and be more efficient, then if we don't understand what our customers want, we are not going to be able to create the value that is essential. Okay, so we need to identify what it is that the customers really perceive as value. Okay, and then now that we've got some practice in breaking activities, if we'll go through a flow chart or some way to document all the processes, all right, all the pieces that go into creating that value that we have. Now, we can even look at processes before we obtain materials that are done by our suppliers, things like that. Even those can add value, and we can maybe consider that those steps and those activities as well. So this is going to become quite detailed in terms of what has to happen, and you can see how this would be very difficult for if each of your products or anything went through a different set of activities. So, but it is kind of essential to understand what it is that we're going to do for our customers and how to best achieve that with the least cost. Okay, so then once we know what the activities are, we're looking for what costs happen because of those activities, right? That whole idea of a cost driver. What does those activities cost us on a individual basis, in how much time they take or in resources that are used? Okay, so try to put it in terms of dollars. Classify all activities, value added or non-value added. That's harder than it sounds, okay? But those things that the customers are actually willing to pay for versus those we do just because we're not efficient or something like that, okay? now that we've identified the activities and what our customers are willing to pay for, we compare it to what the actual costs to do that are. And the places where we are not providing value, but the costs are, or the value is not that we're providing is not higher than the cost, maybe we think about outsourcing that, or maybe we need to find better ways to do that. And maybe even eliminate non-value added activities while adding efficiency to the value added activities by reducing costs, perhaps looking at alternative ways to provide that value in a more efficient way. All right? So, and then you're going to this is the kind of thing that you get to do over and over again as you continue to look at more products, different customers, as your activities change, as the automation changes. All of those things are going to have to be relooked at. So when we were talking about activity-based costing, we talked about cost hierarchies. And one of the ways that this becomes important, the idea of the difference between where an activity is, where the costs come from. Is it because there's more volume? Is it more because of each batch we start? Is it because we have a lot of different products? Or is it because we have the facility and the size of the facility? Okay, that gives us a hint as to where to look to manage it, right? If the cost is caused by volume, then we look to become the most efficient at that volume. Okay? If it's batch related, then we are thinking in terms of maybe we can do more in a batch so that we make the cost to set up the batch more efficient because the batch runs for longer. Because increasing the size of the batch isn't going to change anything volume related. Okay, because we're going to create the same volume. We're just going to do it in fewer batches, which would manage our batch related costs differently than we are currently doing that. So having the hierarchies kind of in the back of our mind will help us uncover where the costs are that we need to manage. So when we are looking at customers and whether they are profitable, our time to serve those customers is money, okay? And when a customer absorbs more of that resource in our business, okay, then we need to either, find a way to charge that greater value, or we need to find a way of more efficiently providing that service so that it doesn't hurt that profitability. So customers, suppliers, they use resources. Some use more than others. Okay, you've noticed that in standing in line when somebody ahead of you takes more time to check out, more time to ask questions, more time, that sort of thing than everybody else. Or you notice that some people are very fast, some people spend a lot of time. Okay, so that's one of the things we try to do with, and those are activities, and we want to see what costs are being driven by the particular customer. Whether it's asking additional questions, whether it is demanding a higher level of quality, whether it is, always on the customer service line, whatever that is, we need to try to identify those activities. So the process goes, we identify the activities that consume the resources, identify that cost driver. What is it? Is it time? Is it a number of items? What's the cost driver? And then compute that cost per cost driver. This is the same thing we learned back at the end of chapter 9. Okay? And then we'll assign the cost to customers rather than to products or to that sort of thing. We're identifying it by customers based on the volume of the cost drivers that they use. So we're basically taking the same process we learned earlier and applying it to a customer base. So this is a situation where we're looking at two different customers. Okay, and then we're kind of treating all the others as kind of separate. So we're kind of trying to narrow it down, look at just two customers at a time to make our maybe we can wrap our head around it. So both Mario's and Claire's have $50,000, okay, of sales. Cost of goods sold is the same because we're selling them basically the same products. All right, and the cost for delivery that everybody pays 18 or 16%, or in this case, because they bought $50,000, $8,000. So the question is the delivery costs. So we have tried to make our delivery charges equal to a percentage of revenue, completely variable, all right, and the same based on dollars amounts, not based on how far it is or any of those types of things. So we are going to look at that delivery cost and try to see if it really is true that Claire's and Mario's use the same amount of resources out of what we are providing, and therefore would justify the same amount of delivery charge cost being allocated to each of those customers. So we go back and we think through, okay, what is it that gets an order out, enter order, we pick the order, and we deliver it, right? Three activities, if you will, all right, that consume our resources. So we pick a cost driver for each one of them, entering the order, number of orders entered, picking the order, number of items picked. So now we're talking about if there's a single order, but it has lots of items, it would take more time to pick than if it just had one item. And then delivering the order is based on how many times we actually have to go out and deliver. So if we can deliver more things in one delivery, then obviously our cost driver, or number of deliveries made, is going to go down. Okay? And then there's just the part of it that can be just based on the value of the order. So when we do that, we figure out that entering orders, and this would require us to do some type of a study of what people's time is spent. So we did that, and we decided that entering an order, the people that do that, and the process that happens costs $100,000. And over the course of a year or some period of time, whatever period of time we want to choose to look at, that $100,000 is going to be people that involved there and get paid can do 10,000 orders. So that's about a $10 per order. So the entering the order, and notice we are saying that the entering of the order is based entirely on the number of orders, not on how many items are in the order. Now, then the people who go out and pick the order, pull it off the shelves and put it in some way to send it out. And this doesn't have to be people. I mean, if it's at Amazon or it can be robots, but you have the same idea. Okay, so it costs $150,000 to pick that, and we estimate that would be 75,000 items. That's $2 per item. So on top of entering the order, $10 per order, each item on that has to be picked off of the floor, and that's $2 per item. And then delivering it is based on deliveries, and so our delivering costs, trucks and all that kind of stuff, is $300,000, and we made 12,500 deliveries. So approximately $24 per delivery, right, to deliver it. So, for instance, if I had an order that required delivery and it had 3 items on it, then I would have, the cost would be $10 for the order, 3 items, or $6 for the items, and then delivery costs would be $24. Okay? If I was able to do 2 orders with 1 delivery, all right, and they were willing to wait and stuff like that, okay, then it would be 2 orders, $10 each, however many of items for both orders together, and then there would be just 1 delivery for over 2 orders, and so your amount of orders and your number of deliveries wouldn't be the same, okay? And then you'd have the percentage of the value of the order as well. That's kind of the thing that we really can't do a very good job of allocating, except to just pick the percentage of sales. So you get an idea of what we're doing. We're now going to look at, okay, each individual customer in terms of their orders, their items, and their deliveries, right, to see what the cost would be for those customers. So here's our, you might say, our graphic of how this flows. And here is how we're going to apply this to Mario's and Claire's. So we have this from our earlier slide, these dollars per order, dollars per item, 24 delivery. All right, and we're going to apply that in, to total for Mario's, rather than looking at each individual order and things like that, which I tried to talk through so you could picture it. But in this case, what we're going to do is number of orders times the $10. This is just activity-based costing. Number of items times $2. Number of deliveries, 200 times 24, 50,000 times 5%. Notice Claire's is going to be the same for the 5% because we said their sales are the same. Notice that the number of items are the same for Claire's. The number of orders is far lower. So what that means is Claire typically orders a lot more items per order, right? Mario's is calling up and making more orders. But at the end of the day, they're having the same amount of items and the same amount of costs. Okay, and Claire's is having a lot fewer deliveries. All right? Mario's is in a situation where we're actually making more deliveries than orders. That sounds a little crazy, and I think our example here is to be probably exaggerated in terms of the differences between Mario's and Claire's. But we clearly can see that Mario's, while ordering the same amount of stuff, does it with lots more orders, and sometimes is wanting it so quickly or in some way that we have to make 2 deliveries for 1 order even, which obviously is going to use more resources, and that's what we're trying to capture. So when we do that and we multiply by that earlier cost driver rate, our activity cost for entering orders for Mario's, picking orders, notice that the cost for picking orders is the same, right? Because they have the same number of items. But delivering, for instance, is for Mario's is 4 times what it is for Claire's, and 3 times for the order entry. The other part was exactly the same. So previously, we've been doing it all based on percentage of the value, and here we only do this last part as percentage of the value. And so we see a different activity for Mario's than Claire's. Okay, so something about Mario's way that we do business with them is generating a very much a higher cost, almost double the cost for servicing this customer, helping out this customer, compared to Claire's with the exact same volume. Okay? So, now, one might say, okay, we should just, stop serving Mario that same way. Maybe there are some things we could build into incentive-wise to help to reduce the number of orders. Maybe we could offer an incentive for doing so. I've known some companies that have minimum orders or that sort of thing, with the idea of trying to reduce, because they realize this cost, and this is actually putting dollar amounts to this cost of accepting a whole bunch of small orders rather than kind of pushing the customer to buy all the things they need at once and reducing the number of orders and reducing the number of deliveries. So that's what we're after. I don't know that targeting Mario specifically is the answer as much as it is developing a procedure or process or something like that reduces the incentive to have lots of small orders or deliveries. Maybe a minimum delivery cost such that it does 16%, but it's got to be at least $5 or $6 delivery cost. That means that they don't have an incentive to order small amounts and have lots of deliveries, because then they're not maximizing the cost of delivery. All right. Or we need to be more efficient in how we deliver or something of that nature. Now, this can also be applied to suppliers, okay? And the same idea is that we're buying from certain suppliers, all right? And we want to measure things that they do that cause us to have more costs. So activities, in this case, all right, it's the late deliveries that we're trying to put kind of in the dollar perspective. Notice that Pacific Foods and Coastal Supply, both their average price per pound is so close as to be not measurable, really. In a real setting, 1 cent is probably not worth worrying about. And so the total value, okay, is different. We order more from Pacific Foods, okay, and we have more deliveries. But they have 50% of late deliveries, okay, while Coastal Supply only has 10. So you're starting to get a feel that maybe that late delivery is, is causing us to have more cost. And so let's see if we can come up with a way to try to put some dollar amount to that cost. So here's our attempt to do that, okay? Our additional cost of late delivery per pound is 10 cents. So we have to do other things to make up for late delivery. Maybe we have to bring in additional people to offload fast so that we can meet production. Whatever. That activity is deemed to cost $10, 10 cents, I should say, or 10 cents per pound. Okay? And so Pacific does that 50% of the time, and Coastal Supply does it 10% of the time. So 10 cents, 50% of the time, is 5 cents for the whole thing. Coastal Supply, only 10 cents times 10% of the time times 10 cents is only 1 penny. So that's added 1. Okay? And so the situation, basically, because of the extra cost, makes it more expensive to buy from Pacific Foods than Coastal Supply. Now, this is a scenario where it's not a big difference, but it is a difference. Okay? Another way to look at suppliers is if this was late, well, we still get it. What if they deliver things that are not of high enough quality? So, for instance, if one supplier sends you 100 pounds of stuff and 90% of it is good, okay, then you take the cost of the 100 and divide it by the 90 to get your actual cost per pound, right? If another supplier, you order 100 and you only get 70% good, you pay for the 70 for the whole 100, right? And now this is assuming that you don't get to just send it back. That you have to pay for even the good stuff. But even if you have to send it back, that's a cost. Okay? So you would have to do it similar to this. What was the cost of having to repackage and send back the defective stuff, like this Pacific Coast and Coastal Supply situation? But if it actual stuff it's not worth sending back, that's what you just eat the cost, okay, of the defective stuff. Then if you have 100, you pay for 100, but you only get 70, that's going to be a different cost than the other one where you paid for 100 and got 90, right? So when you figure out your cost per unit, you divide literally by the good units. And when you include the cost into that of unloading and everything like that, that starts to even go higher, because not only did you buy stuff that was not good, you also unloaded it, transported it to your factory, and then perhaps, which is of course the reason why you want to identify anything that's defective as early as you can in the process. And we're going to talk about that quality in just a minute. All right, so that's a couple of ways you might think of your cost of suppliers. Now, when we think about this cost, and especially fixed costs, we need to consider in managing that overhead cost, we need to look at the concept of capacity. Okay? When something is there and we're paying for it and it's not doing anything, that's kind of a big issue. All right? So when we do everything on a per unit basis and things like that, especially fixed costs, it may look as if those fixed costs are going to change based on volume, but they don't, right? There is almost always some unused capacity, meaning we have a building and some part of it's not being used. Or we have people who are being paid salary that have idle time, who are playing solitaire or whatever. So there's a difference between the resources we supply, meaning we paid for, people, space, machines, any of those, and we have to pay for those on a fixed basis, but what they're using or how much of that is being used varies, okay? So we'll take a situation, all right, where there is this delivery cost for our food distributor. Okay, we're not going to mess around with this sales revenue and cost of goods sold kind of stuff. Okay, and we have this delivery fees charged to customers. That's what we're getting in, right? And right now, our total delivery costs equal our delivery fees charged to customers. So we're kind of, that that's just the way it is. And then we're ignoring the things. So we're just kind of really focusing in on these delivery costs. And so we've broken them down into 4 pieces, right? 4 smaller. When we want to focus on something, we want to break it into smaller pieces so we can better understand what's going on. So when we start looking at the delivery costs in detail, okay, and the activities, we realize that, yes, we spent $150,000 on people to pick items. Those folks actually were picking items 90% of the time, and another 10% were not happening. They were being paid, but nothing was happening as far as picking items. Okay? Now, that's not too bad. That's a pretty reasonable thing, because between breaks and because of, other situations, you probably aren't going to be too concerned about if you're using 90% of the used capacity or the capacity provided. Now we start to get to these others, and we find a much bigger percentage that is unused. And that may be a concern. And that's what this is trying to, this process is doing, is looking at that unused resource. Which means that we could enter a lot more orders without having to have more data entry people. We could do a lot more deliveries, okay, without having to incur more costs, all right? Or we could reduce the cost and not hurt our ability to deliver orders. Okay, that's what this is. We're looking at and thinking through as a way of managing those activities. Okay, and so we're comparing, okay, what is actually used to what we could use, all right, or what is the capacity. So a couple of terms when we're talking about capacity. Theoretical capacity is the idea that we could, all right, if everybody was working perfectly, okay, we could achieve this amount of volume. No downtime, no breakdowns, nobody's missing, okay? That's really, while it might be something to keep in the back of our head, it's not very useful in managing because it's never going to happen. More helpful probably is either practical or normal, or looking at some comparison of those two. Okay, practical capacity means, okay, yes, we got to have breaks, we got to have people downtime and things like that. This is what we could do if that we take into consideration. And the normal is kind of looking back and saying, oh, this is what we have been doing, and we project that we're going to keep doing that. You would hope that your practical capacity and normal activity are somewhere close. But there may be times, okay, when you have even that more capacity than your normal activity, okay? And one of those is especially a situation where you have seasonal demand, meaning you have much more demand in the summer or the winter than in the opposite. So if you just to keep for simple purposes, if you are a swimming pool, right, your capacity is very much about the summertime, right? If you're a ski resort, it's very much about the winter time. If you're a travel company of some sort, you may find that, yes, you have a busy time, summer, especially if you're catering to families who are out of school, but you still can get some capacity in the wintertime. It's not zero, like you might say with the swimming pool, where in the wintertime, at least in Pennsylvania, you have zero. Nobody's using it if it's an outdoor pool, okay? And a ski resort isn't getting used in the summertime, vice versa. But you may have changes in volume. So let's take, for example, and we remember from an earlier discussion that our airlines, anybody that has to fly airplanes, they have a lot of fixed costs. And so understanding those fixed costs is important, and that's what activity-based, this kind of process is. And so what we're looking at for this Northern Air charter is that last 3 years they've had fixed operating costs, which are very fixed. You can see that. They have to have those planes, they have their pilots on call, whatever, and they've had a fluctuation in the number of passengers. And you see what happens when that is the case. The amount of cost per passenger fluctuates as well, right? You take 400,000 times divided by 2,000, you get 200. Divide by 2,500, 160. Okay? If you use, those are what's actually happened, but you could also apply that same thing to different measures. If you, theoretically, everything worked perfectly, we could run 4,000 passengers. Okay, that's what our planes would handle if they were in a constant rotation being used. And that would be $100 per passenger, but that's not practical. Practical, more like $3,200, but that's still more than we've ever done before. The normal, if we consider year 2 to be the normal, is $2,500, which is $160 per passenger. All right, and then we've had year 3, not so good year at all, and that was only $1,600. Okay, and you see the cost per passenger there. Here's the tendency. If we're using this kind of calculation to price our product, we see something happen, and that is that as the activity goes down, the cost per passenger goes up, and therefore we may be tempted to charge more in a bad year our customers, which is simply going to make our volume fall further. It's going to make the customers have to pay more, and therefore there'll be fewer passengers, and we'll have even worse fixed costs per passenger. All right? So this scenario is that we have the winter time where we kind of have around 800 passengers, and we have the summertime when we have 1,600 passengers in total, right? The thing is, during the winter, we can't get rid of the planes. We still have to have the same planes, pilots, and stuff, even though there's lower demand. That's the unused capacity or excess capacity. It's that the cost of those airplanes just sitting, or that pilot just not doing anything. Okay? Now, during the summer, we don't have that problem, right? Because we have enough passengers. The question is, how do we treat the costs of the excess capacity when we don't need it? How do we deal with that from an accounting standpoint, or even a management standpoint, if we're looking at how to set our prices? Okay? So this is a spreadsheet kind of showing some ways you can think about it. Okay? So the cost for winter passengers. So if we think of it as two products, winter, summer, all right, what if we assign all of the excess capacity costs to just to the income statement? We don't even count it as a cost of our passengers. Okay? All right, so if we do that, then the cost for winter passengers is just the other 100,000 for the time that we're actually flying in the winter. All right? If we divide the capacity, okay, amongst all of the passengers equally, seems like the fairest, then our cost per passenger is $16.67. And notice that's the same for summer and winter. So this is the same process, but done for summer passengers, where there's 1,600 passengers instead of 800 like there is for winter passengers. So if we put the $100,000 in period costs, that leaves us $100,000 for 800 passengers, or $125. Okay? If the excess doesn't affect summer, so summer still has $200,000 for 1,600 passengers. All right? If you all passengers equally, you just take the full 400,000 and you divide by the 2,400 passengers. 1,600 in the summer, 1,800 in the winter. Okay? Simplest. All right? Every passenger looks like they cost the same amount. Okay? Winter passenger, if we say, okay, the excess capacity is in the winter, so let's charge our winter customers that. Let's look at it as a cost for winter passengers. Okay? Then those winter passengers have the 100,000 to actually fly them, and the 100,000 of excess capacity for 800 passengers. That's $250 each. And of course, none of that cost goes to summer passengers, so they get just the 200,000 for 1,600. Now, here's the secret. The reason we have excess capacity in the winter time is so that we can meet demand in the summer. That cost of having the extra planes or the extra pilots is not about winter. If we only had 800 passengers all the time, we could cut our fixed costs. We could get rid of airplanes, we could get rid of pilots or whatever. But because we need that in the summer, it really is a cost of flying in the summer. So that's what this last thing does. It takes that 100,000, okay, of cost that we have. Yes, we pay them in the winter, but it really is a cost of meeting demand during the summer. And so we allocate it to our summer. So you have the 200,000 to actually serve the customers in the summer, and 100,000 for the extra capacity you have all winter because of the summer. Add that together, divide by the 1,600, and you see this is probably a more realistic view of the cost per person. And it's going to give us that idea that we should probably, during the winter time, when we want to create more demand, charge a lower price, because our cost literally is lower per passenger. All right, we don't want to increase demand in the summertime. Right now, we couldn't meet that demand. We're already at capacity. But we could increase our capacity we could fly more passengers in the wintertime. And that's what this measures. It says, okay, that's going to cost $125. We want to look at what we should charge customers. We would start with that 125 and then try to work in through a profit and variable costs and that sort of thing. Okay? Now, quality is an important part of our managing costs. Okay? So first of all, you need to go back to that idea of value chain. It's quality based on what the customer perceives as quality. Okay? And we need to try to work towards meeting their definition of quality. Okay? So to do that, though, we have to have an internal look at what we do stepwise during the process that will meet that customer expectation. All right. So we try to look at quality from an external view, customer expectations, and internal. What do we do? What specifications do we have to put in place to achieve that customer, that quality? So external, if it's performance or taste or functionality, that's maybe tangible. The feeling they get is more intangible. The customer service, they rate high ratings on customer service, getting the delivery time on time. If we move towards conformance to what we have as specified, that's conformance internal process. So here's the balance that a company has to do, okay? The costs to prevent. What do we do to make sure that we conform to our high quality standards? We might have to inspect materials. We might have to change our processes. We might have to train people, okay? Inspect machines, okay? All of those things cost money, all right? With the idea of increasing our conformance. We also may do other inspections of the actual product. So this is, the prevention is, before we work on it, maybe with the materials, all right? Appraisal is after we've done something to see if it meets our specifications. The problem with appraisal is you've limited your ability to you've already put a decent amount of cost into the product, right? If you've made the product and you get to the end and you find it doesn't work, you've already spent the cost of materials, labor, and everything that went into that. And you don't have an item to sell, so you're giving up the contribution margin. Prevention hopefully does it sooner by not starting a process with stuff that's going to end up not working. Okay, but both are important, all right, but it's far more expensive. And what you want to remember when you're working on homework or any of the other applications of this is if you have an item that doesn't meet specifications, you don't, not only do you have costs that you can't recoup because they're spent, you don't have you're giving up the contribution margin that you would have if you had a good unit that you could actually sell. So that's the conformance side. On the non-conformance side, what happens if you don't? That's what you have to pay to make sure you meet specifications. What happens if you don't make specifications? Okay, you have to either rework it or scrap it, throw it out. Okay, you're missing out on that contribution margin. Or you ship it all the way. That's if you catch it before you send it. If you send it and it's garbage, then you're going to either be providing warranty repairs, you're going to be subject to lawsuits, you may be, you're going to have your reputation hurt, you're going to lose all kinds of situations that are from an external failure. So what you want to do is, if you have a total cost, okay, as you do more things to conform, more inspections, more ability to get things right, your external costs, your internal failure costs should go down, right? And the cost to conform should go up. So there's this kind of sweet spot where the total cost is the best, right? Right in here somewhere, it's going to be an estimate where the cost of having bad things sent out or anything is going down, all right, and the cost of all those inspections and all that extra work is going up, okay? You want to be in there in this middle point here. You don't want to have too much cost for nonconformance, and you don't want to have too much. You want to inspect everything 3 or 4 times and spend too much money on that. Okay, so this is how you measure it. And again, some of these costs are more difficult to measure than others. So you have to realize that this is very much an estimate. Okay, and so you probably want to err on the side of more quality, spending more on the conformance costs to avoid the non-conformance costs from customers and that sort of thing. All right, so this might be a way to kind of break it down and cost of quality report, especially as a percent of sales. So you measure your prevention costs and the scrap. Okay, compare it. That last one, customer complaints, putting a cost to that is pretty difficult. And a total quality management scenario or mindset would say there's no way to put a dollar amount. That's almost infinite. So you definitely need to avoid that customer complaint piece. But in reality, there's no way to ever get to zero on those kinds of things.